Asia, Europe, and the United States. This is CNBC's Worldwide Exchange.
I'm Brian Shackman. In the U.S., investors nervously awaiting today's job report, which could show the biggest monthly drop in non-farm payrolls in nearly 30 years.
I'm Maura Fogarty. In India, or in Asia, India is expected to announce a fiscal stimulus package and may unveil more rate cuts this weekend to support a sagging economy.
And I'm Ross Westgate, and Europe equities are in the red with energy and auto stocks leading the way. Merrill Lynch says oil at $25 a barrel is a possibility. That forecast from Merrill's, depending, of course, on what happens with Chinese growth. Let's take a look at where we are with global equities. The FTSE Global 300 is down 27 points. As you can see, European equity markets are now into the trading session following the way the US closed yesterday. Remember, down 2.5% on the Dow Jones Industrial Average. European equity markets right now have losses of sort of, similar sort of magnitude, if we move that on for you. Down 1.8% for the FTSE. The Xetra DAX down near a session low of 3%. The CAC run off near 3%. The SMI down nearly 2% as well. Resources, oil and gas, chemicals, autos are all down this morning. So those most affected to the cyclicality of the global economy and the slowdown are being impacted. On the currency markets, the dollar is down to 92 against the yen at the moment. Euro dollar and sterling dollar both higher than where we were this time yesterday. Euro dollar back over to 127.71, nearly 128. Sterling dollar has a 147 handle at the moment, and dollar Swiss franc is back to 120. More, what kind of day have you had there?
You know, Ross, shares here in Asia actually edged up, but there was still some caution in the markets ahead of that big jobs report coming out of the U.S. later on today. Here's how the markets all closed out for the session. The Nikkei 225 was down, by just actually flat on the downside bias, I should say. The Kospi was up, Hong Kong stocks were higher, and of course you had the Shanghai Composite closing up today. This is the third straight day of gains here for Shanghai, and today we saw a lot of rotation into the food sector and the agricultural sector as well. In the energy markets, oil is still trading below the $44 per barrel mark. Investors are eyeing the psychological $40 level as the global economic slowdown takes a toll on demand for oil. NYMEX is at $43.80 currently. If you look at Brent crude, the front month contract, that's the January contract, trades at $42.45. Over to Brian for a look at how the futures are shaping up on this big non-farm payrolls day. Good morning, Brian.
Yeah, good morning. Good day to you, Maura. Actually, a very dynamic situation where if you lose 250 to 300,000 jobs, a lot of analysts out there think the U.S. markets will rally. Some of the projections are for upward of 500,000 job losses. So we'll see what happens. If you missed the last 60 minutes of trade yesterday in the States, you missed really all the action. We were down about 50. Then we plummeted to about 300 points in the span of minutes, and then recouped a little bit of that, and then we're down just a touch over 200. But now for the week, for the month, across the board, pretty much down 5%. Against fair value, we're positive here, believe it or not. If you crunch the numbers, I know you see all red, but we're positive by about 18 points in the Dow. We're slightly negative in the NASDAQ and slightly negative in the S&P 500. So we would characterize this as a mixed picture. The likelihood is that we will have a mixed picture until that jobs report comes out. I think it's in about 4.5 hours. We'll see what happens there. Quick look at your treasuries, starting with your bond yield, ticking in right now 3.05%. Let's take a look at your U.S. 10-year, and I don't need to beat the drum too loudly. The incredible lows we have, some decades upon decades lows with the 10-year yield at 2.58%. Quick look at gold. Right now in terms of recouping maybe some of the losses after the dollar weakened a little bit, but it's basically fractional. I mean, it's up $1. 767.45 is where it stands at this hour. More back to you.
You know, the U.S. jobs market may have suddenly gotten much uglier in November. Economists and investors alike are now bracing for what could be the worst month for job losses in nearly 30 years. The government, of course, releasing the November employment data coming out at 8:30 a.m. New York time. A Dow Jones forecast is calling for a drop of 350,000 in non-farm payrolls, which would be the biggest monthly decline since May of 1980. The unemployment rate is expected to rise to 6.8%. That is a 15-year high, while average hourly earnings are forecast to rise just 0.2%. Joining us now for some market strategy is Didier Borowski. He's senior economist and strategist at Societe Generale Asset Management, and Nicu Harajchi, managing director at K1 Fund Distribution. Thank you both for joining us today. Didier, let me throw the first question out to you. What are you expecting the non-farm payrolls to tell us about the U.S. economy?
Well, I think, non-farm payrolls are a lagging indicator. All the indicators point to heavy job losses this month. So I think that we will have something between 300,000 and 400,000 job losses this month. Having said that, I think this is currently expected. This quarter should be the worst quarter since the early 80s, and I think we should not be surprised that job losses are very high at this stage of the economic cycle. The key question is what's going on next year, and that's why we have to carefully look at economic policies.
Nico, what do you think? Are you expecting something similar to what Didier is saying?
We very much expect the same thing, and we have been expecting, and we do expect also for the future, that economic indicators are not going to improve. And we also think that we are going to see continuous downwards pressure on the equity markets across the board.
Well, Nico, so basically, the worst is ahead is what we're getting from the both of you. What are we looking at here? I mean, people are trying to put in perspective the Great Depression and the breadlines, which everyone says we're avoiding with all these measures from central banks, and then some of the broader and deeper recessions. Are we going to get double-digit unemployment here in the States?
I truly believe we are going to see double-digit unemployment rates in the United States, and I also think that I don't think that the fundamental evaluations or the methodology that we have seen in the past is really to apply for the future. Now, a lot of analysts are coming out and saying that we are seeing cheap stocks or cheap valuations. I could only partly agree with that, and that's only in the context of a finance-based economy, which was once dominated by leverage, but low cost of financing and low corporate taxes. However, given that the era of deregulation, low borrowing, and low corporate taxes are behind us, I think we have to apply a new aspect of analyzing stocks for the future.
Oh, Didier, do you look at it as we overuse the word paradigm and the phrase paradigm shift, but are we coming into a whole new era in terms of the global financial picture where, parking your money if you're a person in your mutual fund for 25 years is what you do? I mean, are we going to see a broad-based shift in how everything operates from here forward?
Yes, I do believe that there is a structural change which is currently in the pipeline. The U.S. consumer has to deleverage. It will take time, and we come from a world where the U.S. economy, thanks to the U.S. consumer, was the main engine of global growth, and it will be no longer the case in the coming years. So there is a redefinition of the global economic picture. Countries in Asia, in the Middle East, which are countries which save a lot of money, will have to increase their spending if we want to avoid a global and protracted recession everywhere. So there is a global rebalancing which is in the pipeline in terms of growth.
Didier, the problem I agree with you totally, right? I mean, here in the UK and in the States, we need to save a little bit more. This is the problem, though, right? How are you going to get people in Japan to spend? How are you going to get countries that have a culture of saving to spend? I mean, even in Germany, they've got a high savings rate. They could spend a little bit more. It's very difficult to change that culture, though, right? So if the US doesn't consume, then, actually, we've got a problem.
Yes, we've got a problem, and that's why governments everywhere try to solve this problem, at least in the short run. Turning to the medium run, it will be another problem. But turning to the short run, you have to see all the government implementing huge fiscal packages, because we have to avoid a global economic recession. Private demand is going to slow everywhere in 2009. The main threat is what we call debt deflation, and to avoid debt deflation, governments, especially in surplus countries where savings are very high, have to implement the fiscal package, large fiscal packages.
Which brings you back, Nico, to experiences in Japan, right? They've got huge savings in Japan.
Yes, exactly.
How do you get anybody in Japan to spend money? Well, because that's the key here. I mean, that's the lesson we've got to learn. How do we unlock the savings in the countries that have it?
I very much agree with you, and it's funny. We have had recession in Japan for so many years, and we have had almost zero interest rates, and we still haven't had the Japanese people spending money. I purely and strongly do not believe that the Japanese nor the European consumers, let it be in the UK or the US consumers, are going to spend money just because we're lowering the interest rates. And I think that what the government or policymakers or central banks would have expected in the past, that if you lower the interest rates, people will go out, spend more, you have higher income for borrowers, and you order to damp the currency in order to boost the trades. But I don't think that in the current...
So if consumption habits have changed, right, if consumption habits are going to be very different coming out of this, okay, I mean, that's got big implications for certain industries and for investors as well. I mean, what is the new investment cycle going to be like? Well, what are the things you're going to have to look for?
Well, I think that if we have one example at the current in the world today, I think it's Japan, because Japan has had a crisis for the past 20 years, and it's only been the last 6 years when we had global growth of and you know, China posting more than double-digit figures that helped Japan in the fourth quarter of 2006 to leave deflation behind, and in 2007 to have 2 quarters of positive growth. So I think that you could take that as an example for the future, and I don't see anything positive signs for the future. I think the entire Western world is going to save more and invest less in the equity markets. And I think it's going to take many, many, many years in order to come back to the all-time highs.
Which brings us maybe it's a weak segue with Japan, because where would they be without the automakers, to the question and the discussion of the automakers. And I'll start with you, Didier, if we could just get a sense, and this is a question often asked, and I'll put it to you. Is there systemic risk if the U.S. automakers, at least one of them, fail?
Yes, clearly there is a systemic risk, because the unemployment rate would soar, and the main risk in that case is that you would have a jump in the household saving rate, and in that case it could provoke a huge recession in the United States. So no doubt that the Obama administration is going to save automakers. So I think there is no doubt. Currently there is a debate, between the current administration with Paulson, who does not want to use the TARP money to save automakers, and the Federal Reserve. The Federal Reserve officials say that it's not their role to save automakers. So there is a debate currently between fiscal authorities and monetary authorities, but no doubt that in January we will see the next administration taking measures to save the automakers. They are definitely too big to fail at this stage.
Nicu, you can chime in on that, but also on the same token, there's got to be great opportunity here. No matter what happens, the U.S. auto industry is going to shrink, and say the Japanese automakers, which are suffering too, but they are so much more streamlined, so much more nimble. There's a lot of opportunity to get market share for even further.
I agree with you that obviously the car companies which is going to survive the current crisis are probably going to be the more dominant company of tomorrow. However, I think that, not only the triple effect, but we're also seeing a domino effect, isn't that? And that is that first we saw the investment banks coming out and saying they're in great shapes. Then we've seen so many investment banks disappear. Now it's taking on to the retail banks. They said that, they have a retail business and revenue diversified, they're not going to be hit. Now you have the car companies. And the one thing that you see all across the board is that we have these senior executives all coming out saying we can turn the company around, we're going to be profitable. But I think the biggest problem here is the consumer confidence, the investors' confidence, and that is going to continue. But I agree with you, there will be an opportunity for the companies that will survive, and if it will be Japanese car makers, then it will be great for Japan. But I think we still have to see what is going to happen in the coming months.
Didier, it's more here in Asia. What's the best strategy right now then, if you're looking at your investments globally, whether it's in fixed income or in equities? Is there a distinction between the two right now?
Well, currently we believe that the best opportunity is probably in the fixed income market, but more to be more specific, I would say in the credit market, and probably also in the high yield sector. The underlying defaults which are priced currently into markets are much higher than defaults that we will see. This is a recession. This is not that deflation that we will see everywhere. So I think we currently the credit market does offer opportunity in terms of risk return.
All right, gentlemen, thank you for joining us. Didier Borowski, Senior Economist and Strategist at Societe Generale Asset Management, and of course, Nicu Harajchi from the K1 Fund Distribution. Meantime, other top stories we're following here in this region include one coming from India, where the country may announce a stimulus package tomorrow.